Yeah, well, guys, so we have given introduction, a pretty heavy one actually for bond valuations. Let's recap quickly what we have covered, and then we will move on further into the core concepts of bonds. So basically, what is a bond? Bond is nothing but normal debenture, sir. It's a debt instrument issued by an entity. It's a form of borrowing only. Instead of borrowing from a single source like a bank, when I borrow from various investors by issuing them securities, we call it as a debt instrument. A debt instrument usually is very popular as debenture, but in academic purposes and all, we call it as bonds. There is no real difference between bond and a debenture. Having said that, generally, when a government or a public sector undertaking issues a debt instrument, we refer that as bonds. When the same private sector entity issues a debt instrument, we refer them as debentures. So as such, there is no technical difference. They both are equally same for us. Next. Just like a share, bond also has a face value, or which is also called as nominal value or par value. Now, what is the purpose of this face value? The purpose of face value is only one thing, sir. That is computation of coupon. The interest whatever the bond has to pay to the investor, that is computed by applying the coupon rate on the face value of the bond or par value of the bond. Now, even though that is interest, as we discussed yesterday, we prefer to call it as what? Coupon amount or coupon rate. So fine, that is one thing. And next, typically redeemable bonds on the maturity date can be redeemed either at par or at premium or at discount. That's a matter of agreement between the investor and the borrower, right? Then we have also discussed that in order to create liquidity for the bonds, most of the entities, what do? They go and list the bonds on a stock exchange. When you list the bonds on stock exchange, what is happening? You are creating a second-hand market, that we call it as a secondary market. So in secondary market, the moment things are listed, sir, what will happen? The prices are determined by forces of demand and supply, because in the market there are many buyers, many sellers. If there is more buyer for a particular bond, demand increases automatically, price also goes up. When there are more sellers of a particular bond, supply increases, price will fall down. Basic economics, nothing else. Now, when the price increases or when the price decreases, to what extent it will fall, to what extent it will go, what is the ideal price, that entire thing we are going to cover in this chapter. Now, as discussed yesterday, this chapter is predominantly from investor's point of view, not from company's angle. So, what is the meaning of bond valuation? Bond valuation is nothing but determining the fair value of the bond. Now, what is fair value of the bond? Fair value of the bond basically means identifying how much amount an investor should put in the bond in order to earn his desired required return. So, next question, how to compute fair value? Fair value is nothing but all future cash flows, whatever are there, happily discount it off to today, using which rate? Required return of the investor. Now, in a typical bond, future cash flows are what? Only coupon interest and the maturity value. So, take the coupon amount, take the maturity value, discount everything to today using required rate of return. Now, usually in a redeemable bond, the coupon amount every year will be same. Since it will be same, instead of sitting and discounting individually, we directly apply an annuity factor and discount it off at once. Next, required return. As discussed earlier, required return is based on two things. One is the market interest rate, which is the general risk-free rate. And what's the other thing? The riskiness of the borrower. If I'm investing money somewhere, it's like I'm giving money to somebody. Depending on how risky that somebody is, how much extra return I want depends. For example, when you give money to government, you are expecting only a return of how much? 6%. When you are giving money to Reliance Industries, you are expecting a return of 10%. When you are giving money to some company which is newly formed, that's even more riskier, you want even more higher return. Higher the risk, higher the return. Lower risk, lower return. No risk, risk-free return. So this is about required return concept. Now, as an investor, how will I know whether a company is riskier or not riskier, how much risk it has? That depends on what? There is something called as credit rating. Credit rating is done by individual and agencies which are appointed, and when at the time of issue of bond, the company will tell the investor, see, we got this rating from the independent authority, so you can trust me to this effect. So accordingly, the return what I am offering is reasonable enough. If you find it, please come and invest. So it's like an opinion expressed by an independent agency about the willingness and the capability of the entity to repay the amounts borrowed from the investors. So that is called as credit rating. Looking at the credit ratings, investor will understand how risky the company is. Now, innocently, you should not think that when so many companies are there, so many companies are issuing bonds, I should go and invest in that bond which is having highest rating, AAA rated bond. No, sir. Because if you go and invest in that kind of bond, no, literally risk is zero and return also will be lower. Risk will be almost negligible, return also will be very small. So, if you want a risk-free return or almost very minor risk only you want to take, you can as well do a fixed deposit also. If you are coming to bonds means, you basically some people wants to take some risk. So it's not that always you should go for AAA bond and all. Where you will invest, that's a matter of your risk perception. So there will be one fellow, sir, that fellow feels that I will take more risk, I will take more return, I don't mind in a particular if default happens. So that kind of fellow will go for a lower credit rated bond which is promising to pay a higher interest rate. Okay, so don't make any conclusions out of which bond I should invest. No, sir, not like that. So where you will invest, that's a matter of risk return preferences of the investor. You can't say that you should always go and invest only in a AAA rated bond, top category bond, not required. It's investor's choice. Next. Okay, fair value of a coupon paying bond we have discussed. Next, zero coupon bond. Tell me, sir, what is the meaning of zero coupon bond? In a zero coupon bond, the bond does not pay any coupons. It will pay only maturity value. So basically, how will the investor earn his return then? The bonds are issued at discount and redeemed at par. Now, how to work out the fair value of a zero coupon bond? All you have to do is zero coupon bond ka maturity value, single cash flow, whatever is there, discount it to today. Just multiply with PVIF. Got it. Next. Perpetual bond. What is the meaning of perpetual bond? A bond which does not give you your maturity value at all, but forever it keeps on paying you coupons. And coupons it keeps you paying forever fixed amount. This is falling into a level perpetuity cash flow. Therefore, present value is equal to coupon amount divided by RR. That's all. Then we have gone into questions. Now, questions are very interesting observations came for us. Now, there was one scenario where we worked out the fair value of the bond. We interpreted the meaning that if I want to earn a return of 12%, I should buy this bond at 891.83. Whether you will be able to buy this bond at 891.83 or not, that is not in your hand. That depends on market price of the bond. Now, market price of the bond, if it is coincidentally 891.83, we'll say that the bond is correctly priced. I want to pay that much, market price is also quoted like that only, bond is correctly priced. When something is correctly priced, definitely you should go and buy the bond. Fine. If you buy the bond, how much return will you get? Your actual return will be equal to your required return when the bond is correctly priced. Suppose to your surprise, you found the bond at a lower rate. If you find the bond at a lower price like that, we call the bond is underpriced. If you buy an underpriced bond, what will happen, sir? You will end up getting a return more than your desired required return. Correct? This actual return, whatever you are going to get, that is referred as what? Yield or yield to maturity in this chapter. Today, we will be learning how to compute that YTM. Next. If actual market price is 910, it is more than 893, which means the bond is overpriced. If you buy this bond, what will happen? You will definitely get a return, there is no doubt, but that return will be less than your required return. Ideal answer is you should not buy. If you already have this bond, sell the bond. Then, I have given an example. The example ultimate summary is this. Bond ka cash flows cannot change, sir. Bond ka cash flows are already fixed. So, if you discount all that bond cash flows to today using required return, then the result is called as fair value of the bond. That's a paper number. Fair value is not reality. Fair value is your homegrown calculation. If question nothing is given, then we'll assume that fair value and actual price are same. Bond is correctly priced and we'll assume. But as such, when you discount anything with required return, you will not get actual price of the bond. You will get only fair value of the bond. If you want actual price of the bond, then your discounting rate should be what? Yield to maturity. Total take IRR and discount it off. If you discount it with IRR, automatically actual market price will come after you. Clear, sir? Then last we have done a couple of questions on semi-annual bond and all we have done. Hello. We'll go to another question. Not you, not you, not you. One is over. Two I have discussed with you. 3 I have done. 4 you handle on your own. 5 I have done. You want to try sixth one? Please do sixth one. A PSU is proposing to sell an 8-year bond of rupees 1000 at 10% coupon rate per annum. Okay, 8-year bond, 1000 rupees face value, 10% is a coupon rate. The bond amount will be amortized equally over its life. What is the meaning of bond amount amortized equally over its life? Normally what is happening, bond face value, when will you get back? At the end. But here it is not like that. Every year they will pay. So it's not like 1000 rupees you will get at the end of 8th year, you will get it every year. So 1000 divided by 8, every year 125, 125, 125, you keep on getting. That means along with the coupon, principal amount also is getting repaid over a period of 8 years. If the investor has a minimum required return of 8%, what is the bond's present value? Sir, is some previous questions, where is the difference? The difference stands only where maturity value is paid at the end of the period, whereas here it is paid every year. Since it is paid every year, simple, every year cash flows will not be same. Why it will not be same? Your principal repayment 125 is same. Along with that coupon also will come. Coupon plus 125 total will not be same every year because interest will keep on reducing. Since the total cash flow is not same, you cannot apply what? Annuity factor. So you have to do individual discounting of each year ka cash flow. That's all. Please do it. 1000 8 years and 10% coupon rate. Discounting rate is 8%. Fine. Question number 6. Amortizing bond means the principal of the bond, right, face value, more easy, is repaid each year equally, which in this case is 1000 divided by 8 years, which is equal to rupees 125. So every year 125, 125, 125, you keep on paying like that. That fellow's required return is given as 8%. Every year principal cash flow number will be same. But as principal is getting recovered every year, your next year ka coupon amount will not be same. The total cash flow will not be same. The annuity factor you cannot apply. Individual P factor say you have to do. There is no choice. So, first year ending you will receive principal of 125. Coupon. Throughout first year, how much is outstanding? 1000. On 1000 they will pay you coupon of 10%, which is 100. So total is 225. Second year, another 125 you will get. But this time interest you won't get 100 because out of 1000, last year ending they paid you 125. Outstanding balance is only 875. On 875 rupees, 10%. So that's 87.5. This will be 212.5. 125 Now out of 875, 225, sorry, 125 is paid in the last year ending. So 750 is outstanding, that into 10%. So which is 75 is 200. Okay, now you can understand a pattern. If you look at the total cash inflow, it's coming every year lower by 12.5, 12.5, 12.5. Why 12.5? 125 rupees is getting paid now, on 125 rupees 10%, 12.5 interest amount is reducing every year. So hereafter, innocently don't work out all this. Directly, if you don't have time, sort out like this. 187.5, 175. After that, 152.5. Correct only, yeah? Check once. 150, 162.5, correct. And then 150, yeah? Finally, 137.5. That's it. If you want to fill up, you can fill up. There's nothing wrong. Well, okay. Now, PV factors 8%. 3 or 4 decimals you take and do it off. Generally, questions only they will give you the PV factor, sir. The question does not give, you sort out on your own. 3 or 4 decimals will be fine. That's it, sir. Total it, please. Don't fill up the last column. Just multiply on your calc and get the final answer. That's it. Don't do unnecessary calculations. Waste your time. One zero seven 1070. 0.39 I'll take. It's just similar to previous sums, sir. Conceptually, there is no change. Bond ka cash flows pattern change is there. Hence, we have a bigger table. That's it. You got 1090 here by 20 rupees. 20 rupees is not rounding off error. Check again. If it is my book club printing error, then that's okay. 1070 is fine. Yeah, fine. Check the cash flows in the book. Why is it not matching like that? It should match, no? 1070. We'll change it to it. Correct it, sir. Make it 1070. Fine, sir. So this is one question. E-model never came in your exam though, till now. Let's try this one and then we'll go to new concept. Calculate market price of 10% Government of India security currently quoted at 110. Now you interpret each number, but interest rate is expected to go up by 1%. What is the meaning of all this? Don't see the answer. On your own, independently interpret the question, please. 10% Government of India security means 10% is what here? Good. 10% is correct coupon rate. What is 110? Okay, nice. This is actual market price. But coupon rate has to be applied on market price of face value. Face value. Face value question they did not expressly give you, but it is implied. How much? Good. So the face value of the bond is 100 and that is implied. Okay. Tell me, how will you interpret this one? Interest rate is expected to go up by 1%. How will you interpret that? Coupon rate will increase by 1%? No, sir. Coupon rates are fixed. Coupon rate cannot increase. Coupon rate is 10% and they told no already. How will it increase? It will not increase. Coupon rate is fixed, but market general interest rates can rise. Is it possible? For example, watch this. Sir, market risk free rate was 8%. X Limited and a company is there. This fellow was issuing a bond. Since this fellow is issuing a bond, X Limited is not a risk free company, it's a risky company, so I want more return. This fellow offered a coupon rate of, let's say, 10%. I am investor. In my mind, what is running is my required return is also equal to 10%. My required return, that fellow's coupon rate, both are matching. Will I buy the bond or not? Definitely I will buy. So this fellow bought the bond. After I buy the bond, what happened? Market risk-free rate went up to 9%. Government increased the risk-free rate. If risk-free rate increases, my required return will increase or decrease? Increase. So now my required return is 11%. But I already bought the bond whose coupon rate is only 10%. Are you understanding what I am trying to say? Coupon rate will not change. My feeling will change. At a particular risk-free rate, I added some risk premium and then I was expecting 10. Coincidentally, bond also was offering 10. I purchased the bond. But after I buy the bond, market interest rates can change, It can increase also, decrease also. It increased. My required return also increased. My feeling changed. Bond ka cash flow will not change. Bond ka coupons will not change. Nothing will change. But you tell me, sir, is this fellow happy or sad or no? If you are that investor, will you be happy or sad? Why sad? Today your required return is 11%, but that bond won't give you 11% because you purchased the bond at a 10% coupon rate. Are you understand, sir? You will never get your required return in this bond. You already bought it. Am I clear here? Like that. So what will you do since you are not happy? Not happy boy. What will he do? Since he is not happy with the bond, this fellow will sell the bond. Next question. If he sells the bond, somebody has to buy, no? Who will buy? If he is not happy, nobody is also happy, no? What will happen? Company will buy, no? Company says, don't show me your face in the next 5 years. Since nobody is willing to come forward to buy this bond, what will this fellow do? He will try to sell the bond at a little lower price. Still nobody comes. Even more lower price, nobody comes. Even more, yes, somebody will come. Sir, why is that somebody coming? When the price drops, even though the coupon rate is 10%, since he is purchasing the bond at a lower rate, he will be able to get his 11% return. Are you understanding, sir? It's all pure economics here. Are you getting it? So I purchased the bond. I was happy on the first day. It's like marriage only, sir. Initially happy. Later on, trouble started. Of course, I can't sell it, but here this bond, this fellow is trying to sell the bond. If he's trying to sell the bond, who will buy? nobody will buy. So what will since he is unhappy, nobody is happy with this price. So what will happen? He'll try to sell the bond at a lower price. If you try to sell the bond at lower price, somebody who purchases the bond at lower price, that fellow will get 11% return. You won't get, because you purchase the bond at par value. So this is how economics work. Like that. Come back to the question again. 10% is the coupon rate. Bond ka market price is 110. But what is it trying to tell you is, today interest rates are expected to go up by 1%. If interest rate is expected to go up by 1%, the only point you have to catch from that is my required return also is going to increase by 1%. So your required return until now is 1. After increasing by 1%, it is changing. The revised required return you have to work out. So your job is to work out the market price of the bond. Let's compile all the data, sir. This is a very simple question, but lot of concept is required to handle this. Come here. Coupon rate is equal to how much? 10%. What about maturity period? Read the question quickly and tell me what is the maturity period. Not given. Read 100 times, you won't find. Sir, not given means I will assume 3 years. If you assume 3 years, this boy will assume 8 years. It's lucky number 8. 16. You will all get different answers, no? The assumption wrong. What should I do? Then there is one assumption which if you make, everyone will get the same answer. Which one? Perpetual bond. If the bond does not, the question does not give you maturity value, it means there is no expiry date. It will live forever. Tell me now, price of the bond formula. Coupon amount divided by RR. What's the price of the bond given? 110. Coupon amount 100 into 10%. Required return. That I don't know. So required return from the bond is 10 by 110. 0.0909 or 9.09%. In 9.09% is your existing RR. Now twist. What is the twist? Now interest rates in market gone up by 1%. Therefore, required return from the bond will also go up by 1%. So what is the revised RR now? 9.09 plus 1, 10.09%. He is asking revised price, that's all. Our workouts are 10 divided by 10.09%. The revised price of the bond. Observe the story. Market price of the bond was 110, 110. From 110 it has fallen down to 99 rupees ki padipoyindi sir. Why? Natural. Market interest rate increased, my feeling changed. I don't like you anymore. When I bought it, I would have liked you, because at that time my RR and the yield, everything was matching. Now bond ka yield cannot change because of the fixed, but your feelings can change. Because your feeling changed, a bond is no more likable for you. You try to sell the bond. When you try to sell the bond, nobody will buy the bond at the price at which you have bought. So you have to sell the bond at a lower price. Like that it happens with everybody. So price will fall down. This is that story. Let a small note for clarity. We have to assume that bond is correctly priced. Since the bond is correctly priced, what is the meaning of that? Fair value of the bond is equal to actual market price of the bond, and therefore required return is equal to YTM. Why a note has to be given to you? Because somebody told you yesterday that if you discount cash flows with RR, the result is called as fair value of the bond. But look at the requirement of the question. They are asking calculate market price of the bond. How will you compute market price using required return? I can't. You have to assume only one thing. Assume that the bond is perfectly priced. When the bond is perfectly priced, fair value, actual price, RR, YTM, they are all same. Hence it works. Let's take one small concept now. Yeah, take to your concept part, sir. Till now what we have covered is the basic meaning of the bonds, face value, coupon rate, coupon amount, maturity date, redemption. Up to here we have covered. Types of bond we will discuss later on, sir. Broadly few have covered. Discount bonds or zero coupon bonds, we have explained this. Coupon paying bonds we have discussed. Perpetual bonds we have discussed. Amortizing bonds also we have discussed. These things will come later on. Next. Bond valuation ka meaning we have discussed. Bond valuation depends on future cash flows and discounting rate. Future cash flows are these. Discounting rate is your required return. So higher the risk, higher the required return, lower the risk, lower the required return. And it also depends on the market interest rate. You have just now seen a scenario where market interest rate changed, required return changed, bond ka price also will change. Coupon paying bond ka valuation formula, zero coupon bond ka valuation formula, perpetual bond ka valuation formula. Here I want you to read this point once again slowly, sir. Please carefully read, all of you. I know you know, but still you read. The price calculated above is a fair price or theoretical price. It is the price at which the bond should be purchased in order to earn the required return. The actual market price of the bond may or may not be equal to the bond price, or rather write fair price, it's more correct. May or may not be equal to the fair value is more correct instead of bond price. Okay. Therefore, a bond can be correctly priced or underpriced or overpriced. A point is very important for you now. If nothing is mentioned in the question, we have to assume that fair value of the bond is the actual market price of the bond. Underpricing, overpricing kind of questions, anyway the question will tell you what is actual price, you are supposed to work out fair value. So in that case, underpricing, overpricing, some decision making you will take. But if the question is not asking you any decision, they are simply asking you to compute a price. In that case, you do not differentiate between fair value and actual price. Both are same for us. We go with a fundamental assumption that the bond is correctly priced. That is exactly what we did in this question. See, sir, He's asking market price. We used RR. Ideally with RR you will get only fair value, but I have to assume that fair value and actual market price both are same. The bond is correctly priced. That's how we reach the conclusion. Sir, in concept book too, you have to integrate everything. Everything will match, sir. Every point will be there, everything will match also. Sorry. Yeah. When current market price and theoretical market price, that is the price at which we calculate by applying present value concept are not same, we will undertake following decisions. First scenario, if actual market price is greater than the fair value, we call it as overvalued and decision is to sell the bond. If market price is lower than the fair value, undervalued or underpriced, and you will buy the bond. If they both are same, correctly valued, hold the bond or buy the bond. Clean price, dirty price, we'll talk in some time. Come to EBIT. Guess what we are going to discuss is pretty simple, but just to keep one small check in your mind. I am not talking about decision making. Decision making means whether to buy the bond or sell the bond. This decision when you will do is when bonds are not correctly priced. I mean either it is overpriced or underpriced, then only you have to apply your mind and think. This is not that case. I am going to show you 3 scenarios. In all the 3 scenarios, you believe very strongly in your mind that the bonds are correctly priced. So don't tell me buy, sell and all. You will anyway buy. Okay, sir? Remember this. This is altogether a different scenario. Read now. A Limited issued a bond with a life of 5 years. Coupon rate is 10%. Par value is 1000. Okay, 5-year bond, coupon rate 10%, par value 1000. The bond is also redeemable at par. Nice. Calculate the price of the bond in the following cases, assuming that the bond is correctly priced. Bond is perfectly priced. There is no issue with that. Case 1. RR is equal to 10%. RR means required return. Second case required return is 12. Third case required return is 7. Now since my RR is different, prices also will be different now. Right? So first scenario, since RR is 10%, I discount all the cash flows with 10% discounting rate, and to my surprise I find that the bond value is exactly equal to 1000. What is 1000? That's nothing but the par value of the bond itself. That means here one small conclusion is there. What is that conclusion? When RR and coupon rate both are same, when RR and coupon rate both are same, bond will be trading at par value. I am not talking underpriced, overpriced and all. These are all scenarios of correctly priced only. Okay, what I am trying to say is I am giving a comparison between actual price and the face value, par value, not fair. Actual, fair both are same. Our price is equal to par value, more than par value, less than par value. That discussion we are doing now. Okay, so when required return and coupon rate both are same, bond ka price ideally should be at its par value. So that's the conclusion here. The price of the bond will be equal to its par value. Now come here. RR 12%. Investor wants 12% return. Coupon rate is 10%. The company pays every year annual coupon of only 10%. Work out the price of the bond. How will you work out? Simply discount everything with 12%. How much price did you get now? 928. Now tell me, sir. Compared to face value, it is at premium, discount? Discount. Now, should I buy the bond? In a question I am not asking. I will buy the bond anyway. Bond is correctly priced. I don't care whether it is at par, premium or discount. That's not used for decision making purposes. My question here is different. If you buy this bond, which you will do, if you buy the bond at 928, how much return will you get? You have only one choice. Correctly answer. If you buy the bond at 928, how much return will you get? 12%, that's all. 12%. I do understand, sir, bond is fair, sir, fair value. If you buy the bond, your return will be equal to your required return, which is nothing but 12%. Are you getting it, sir? Now, general question which student asks me is, sir, if bond A pays 10%, how will the investor get 12% return? That's the question. What is the answer for that? 10% anyway you are getting, no. Not only that, today you are buying the bond at 928, but at the end of 5th year you will get an amount of 1000. There is a capital gain component also, no. Are you getting it, sir? There is a coupon every year cash flow. Then towards the end you will have a capital gain also. Coupon 10, a capital gain worth is around 2%. Overall I will get my desired return of 12%. Sir, remember, when you buy the bond at fair value, you will get what you want. You will definitely get what you want. You want how much? 12. You pakka get 12. You understand what I'm trying to say? Chalo. Case 3. RR 7%, coupon rate 10%. Required return is 7%. Coupon rate is 10%. When you discount it with 7% now, a bond is now trading at 1123, which is premium to the par value. Don't call it as overpriced. It's premium to the par value. Since it is a premium, if you buy this bond at 1123, how much return will you get? 7 required return. 7 you will get. Sir, company is paying me 10%. No. No, sir. Company pays you 10%. But today you purchase the bond at 1123 and towards the end you will get back only 1000. There is a capital loss waiting for you. So 12%, sorry, 10% coupon. But there is a loss. Both put together, effectively your return is only 7%. You understand, sir? This is another observation, sir. So let's compile like this. Coupon rate is equal to required return. Then bond will be at bond trades at par value. If coupon rate is less than required return, then bond trades at discount. Sir, you remember one logic correctly, everything else will fall in place. This logic is easy to remember. I want this. Bond is only giving this. I will get what I want. How will you get? Your every year cash flow is lower, but still you will get what you want. That is only possible when you have a capital gain. Who will get capital gain? Somebody who buys the bond at discount and ultimately gets maturity at par. That fellow will have a capital gain. So bond trades at discount. Okay, next. Coupon rate is more than required return. The bond trades at premium. Here important point is, this is only for observation. Not for decision making. Okay, I have questions, answer this now. You will give me decision here, sir, last concept. Okay, first scenario. Actual market price of the bond is 970. Fair value of the bond is 950. Face value of the bond is 1000. Tell me, will you buy the bond or sell the bond? Or rather answer overpriced or underpriced? General question, sir. There is no big. Overpriced, underpriced. Bond is trading at par, premium, discount. First case है बहुत सारा. Good. Bond is trading at discount, but the bond is overpriced. So So in this case, answer is bond trades at discount to par. Discount means not cheaply available. The face value, if you compare, it is lower than that. But the bond is clearly overpriced. Why the bond is overpriced? Actual market price is greater than the fair value. That's the reason. Answer is what now? Buyer, seller? Sell. Don't buy. Answer is don't buy if you want to buy. If you already have, sell the bond. Okay, next case. Tell me, sir, for discount, you have compared what? These two, face value and actual price. For this one, you have to compare fair value and actual price. You should know which and which you are comparing. Actual market price versus fair value. These two ka comparison will give you pricing. And based on pricing only decision. At discount, par, premium, are irrelevant for you. Just observation. Just given in the question to confuse you. Okay, answer this. 1030, 1040, 1000. Answer. Underpriced or overpriced? Okay, first you identified this. Okay. Now that you identified this, happily make the decision first. Something is underpriced, what will you do? Buy. Now let's calmly talk about pricing. Bond trades at par, premium, discount. Bond trades at premium. Okay, another case. 1050. Fair value also is 1050. Face value is 1000. Good. First pricing you identify. Bond is correctly priced. Since bond is correctly priced, you will definitely go and buy the bond. What about pricing? Bond trades at premium. Okay, well, last case. Face value is 1000. Actual market price also 1000. Fair value is 1980. Tell. Good. Bond is overpriced. Since bond is overpriced, answer is what? Don't buy or sell. And the bond trades at par value. So just because bond is trading at par value, you should not go and buy it. Just because it is trading at discount, you should not think it is cheap. Whether it is cheap or correctly priced, that is a decision you will identify not by this, but by this. For establishing the example. Okay, do not get confused. But in a scenario where everything is correctly priced, then these both will be same. Since they both will be same, bond is always correctly priced. Since bond is always correctly priced, the answer is buy only. You not even compare with anything. Yep. Okay. Now, the example what we discussed now. Where was it? This one. You tell me the prices, sir, one by one. When required return was 12%. When required return is 10%. Bond price is how much? 1000. Par value. When required return went up to 12%. Bond price 928. What is the meaning of this is? Reliance Industries issued bond. At that time, market risk-free rate was 8%. This fellow investor, in his mind, what he thinks is required return is equal to 8 plus 2. which is equal to 10%. Is it feeling? E bond is issued at par value. Is issued at coupon of 10%. Face value is equal to 1000. Think from investor point of view, sir. Life 5 years. Think from investor's point of view. Whatever return he wants in his mind, which is 10%, that's exactly matching with the coupon rate. Correct? That means my RR and coupon rate both are same. When both are same, bond will be trading at what value? Par value. So what this company did, it could issue at par value. Par value of 1000 only will now become the market price of the bond issue price first day. Now, if the company issues at 1000, people may buy, may not buy. People will pay 1000 only if their required return and the yield, they both are matching. Otherwise, they will not buy. But here they are matching, so this fellow bought. Happy. Next day, risk-free rate increased to 10%. When risk-free rate increases like this to 10%, my required return is 10. Reliance is risky, so I want 2% more. 12%. My feeling changed off. But still, the coupon rate will change or will not change? Coupon rate, why will it change? Coupon rate will not change. Life lo 1 day over 5 years lo. Life is still almost equal to 5 years. Face value will not change. Still equal to 1000. You ask Ambani, you already know no interest rates will change. Fellow will say all these things are implied. Don't you know that? Fine, he knows that. You only did not know. That fellow knows. So fine, interest rate increased. Now what happens? If you compute the price, market price of the bond fell down to 928. Now why did it fell down to 928? Now this fellow, unhappy boy, he will try to sell the bond. When you try to sell the bond, you purchased yesterday only for 1000. Today if you try to sell it for 1000, nobody buys. 970, nobody is buying. 950, nobody is buying. 930, nobody is buying. 928, one fellow will enter now. One fellow will enter and buy the bond at 928. You tell me, sir, by buying the bond at 928, that new investor, will he be able to earn 12% return or not? He will get. Will our boy get? He will not get. He says offer price at 928. So this fellow managed to sell the bond to her at rupees 928. He is unhappy, but she is always happy. Why? Because she managed to buy bond at 928. By purchasing the bond at 928, she will definitely get his return of 12%. He won't get. Sir, will she be happy forever? That we can't say. After she bought, RR can further increase because risk-free rate may increase. Her Reliance company becomes more riskier, your risk premium may change. For some reason, RR can increase. Of course, it may decrease also. If it decreases, what will happen? Bond price will rise. Let's take that story also. Next day. Risk-free rate fell down by 5%. Hypothetical examples are okay. Therefore, revised required return is equal to 12 yesterday minus 5, which is equal to 7. That's only our last case, no? 7%. Now, you have already calculated what is the market price of the bond? 1123. Market price of the bond crazily increased to 1123. Now, she is extremely happy now. Now, one fellow comes up to her, says, yesterday only you bought this bond for 928, no? Take 929, give off my bond. Will she give her? Why will she not give? Don't tell me market price increase. I'm asking you why she is not giving. Market price, why will it increase, sir? Only if she sells at higher price, then only market price will increase. Tell me. I offer 929. I told 1 real, 1 rupee. What else you want? Give it off. Yes, no, I won't give. Why? What she tells is, see, e-bond gives a coupon of 10%. 10%. But today your required return is only 7%. When your required return is only 7, e-bond gives a return of 10, coupon of 10. So this bond has got one advantage, that it is offering more than what you want. I will only sit and enjoy. I will not give you. If you want, pay me more. Or how much more? That fellow says, I will pay you 5,000. No. 1,020. No. 1,050. No. 1,100. No. Then I said, okay, fine. Pay me 1,200. I will give the bond. That fellow says, get lost. If I pay you 1,200, I won't even get 7% also. Because in order to earn a return of 7%, you should buy the bond only at 1123. So the investor will buy the bond only around 1123 range. If she quotes more than 1123, if somebody buys that, that fellow won't even get his 7% return. He won't buy. No fool will pay that. So the deal has to happen only at 1123. Are you understand, sir? There is a fundamental calculation and there is a market analysis also. Both you have to integrate and understand. Clear? See, multiple facets, if you understand, the advantage is you will never get confused. Down the lane, your thinking will be in the right sense. Even if by chance you get confused, some other logic will come and hit you. If you think like this, this is not matching. Again, you will rethink in the correct way. Both you have to learn. Chalo, sir. Let's move on to another question. Question number 7 is over. Come to, sorry, so 7 double printed. Okay, I'll change it to 8. Or else you call it as 7A. Okay, come here. ABC Limited has the following outstanding bond. Okay, what are the outstanding bond? Outstanding bond ka meaning is what? Bond is already issued. It's not currently being issued. It's already issued bond. Two bonds they are having. Series X bond, Series Y bond. Two bonds they are having. Series X bond has a coupon of 8%. Maturity 10 years. Series Y bond coupon is variable. Changes annually, comparable to prevailing rate. What is the meaning of this is, Series Y bond ka coupon rate is variable. Whatever is your required return, that much coupon rate they will pay every year. Initially, these bonds were issued at their face value of 10,000 with a YTM of 8%. YTM is RR only and actual return only. Both are same. Unless there is a pricing error. Okay. So tell me this one line, simple point. First day bonds are issued at face value, and a bond ka coupon rate is how much? 8%. YTM is also, YTM is actual return and required return, everything is correctly priced. So when RR and coupon rate both are same, bond is issued at face value, par value. Your first case ka observation. That he is not asking, the question ka interpretation, all these things should be running in your mind, then only further points of clarity will come. Clear, sir? Tell me, bond ka life is how much? 10 years. Continue, sir. Assuming that after 2 years from the date of issue, 10 years or 2 years is over, interest on comparable bonds is 10%. Today, similar bond, if it is newly issued, they are putting a coupon rate of 10%. What is the meaning of this? Indirectly, this is your RR. then what should be the price of each bond? So he's asking, I issued a bond with 10-year maturity. Out of 10 years, 2 years is over. Today, what is the price of the bond? Assuming that today's required return is 10% in the market. First day required return was how much? 8%. But in a span of 2 years, required return changed. Why did it change? Either the company became more riskier, therefore investor is expecting a higher return, or risk-free rates in the market have gone up and therefore investor is expecting a higher return. For what reason it increased, we do not know. But these are the only two reasons that are possible. So work out, sir, 7A. Now you tell me one small thing. Don't write anything. Just watch. Answer this. Series X bond ka coupon amount is how much? 8%. So nothing is given. Bonds are redeemable at par value only. Now, sir, he is asking you price of the bond on which date? After 2 years, not on first day. First day he only told the bond is issued at face value only. So you are standing here, sir. Second year ending you are standing. Now, what is the price of the bond on this date? Tell. Price of the bond on any date is what? Present value of future cash inflows. Future cash inflows means which cash inflows? Starting from? You are standing at the end of second year now. Third year, future cash flow, not past cash flows. What is already received, for that why will anybody pay money, sir? Future receivables today you can invest. So which cash flows have to discount? From third year to 10th year ka cash flows. Discounted at required return of today. How much required return? 10%. Now, my question only in this is only one thing, sir. Annuity factor, how will you take? That's all is the question. Okay. Tell me. Annuity factor, how will you take? Okay, look at this. Is equal to, I will write two things, you tell me which one is right. 10%, 3 to 10 years, plus 10,000 into PVIF, 10%, 10th year. This is right, huh? Or which one is right? First one, second one. How many of you is the first one? 1, 2, only 2, 3, 4, 5, 6, 7. Remaining all balancing figure. Huh? Second option. Okay, second option answers. Some people who don't raise in both the cases, I will get another answer. Wait for you. 1, 2, 3, 4, 5. Papa? No idea. Okay, look at this. If you are using this answer, if you are saying this answer, you know what is the meaning of this? You are saying that from today, the first cash flow starts from third year. And it comes third year, fourth year, fifth year, sixth year, up to 10th year. And I am standing at 0. Tell me, I am standing at 0 time, huh? Means in the above timeline. I am already standing at second year ending. My first cash flow starts when now? Third year ending. Third year ending is how far from me? 1 year. 10,000 is how far from you? 8 years. So you have to discount 10,000 by how many years? 8 years. Which one is right? Second one is right. Sir, but sir, your doubt is only this. You wrote 0, no, sir. 1, 2, 3. Sir, this is life of the bond. A 0, 1, 2, 3, whatever I wrote, that is life of the bond, term of the bond. Time value of money, they are not the time value points. Time value points are these. Wherever you are standing, that is 0. ఈ particular sum ka objective is to make you differentiate between life of the bond versus your timeline. Life of the bond 10 years, but already 2 years is over. You are standing at the end of second year. Remaining life is 8 years. Wherever you stand, that becomes 0 point. 0 means now. So tell me, sir, 10,000 rupees is how far from you? 8 years far from you. So discounting has to be done with 8 years. This 800 is how far from you? This 800. This is just 1 year far from you. So you have to discount it only by 1 year. So this 1 year, the 2 years, the 3 years, the 4 years, this by 8 years. Now, what are trap in this? These two trap. Don't touch this. Why? These are past cash flows. Therefore, ignore. Chalo, copy this fast. Make lot of mistakes, sir. Lot of mistakes. If you make only, you will learn. Be happily make mistakes. Nothing to worry. These are all time value of money concepts, sir. More mistakes you make, more clarity will come. Wherever you stand, that becomes a 0 point for you. Life of the bond different. Your timeline different. As 0, 1, 2, 3, 4 up to 10 whatever I wrote, as life of the bond. 0 to 8 what I wrote, that is your timeline. So these are all future cash flows. Okay, answer please, final answer. 800 into final answer 8932.92. Okay, 33 you make. Chiller, leave it. If it is right decimals also, nothing will happen. You need not pay, no, you just have to write. That's okay. This is series X bond. Series Y bond next. Series Y bond loan beauty is there. What is that? Coupon rate is variable and it will be always equal to required return. Since coupon rate and required return both are same, what will happen to bond price? Bond trades at par value. Bond trades at par value. That's it. Sir, do I need not compute? You have to compute, but you should know the answer beforehand because you're smart. Can't help it, no. Price of Series Y bond today is equal to, what is the coupon? 10,000 into 10% into PVIFA, 10% 8 periods plus 10,000 into PVIF, 10% 8th period. 1000 into 5.3349 plus 10,000 into 0.4665. How much are you having, sir? Over, sir? Cool. See, what did I change? You are getting comfortable with table. We change the format. This time I wrote in a line equation. Earlier we were drafting table. You, sir, don't get attached to anything. Learn everything. Whatever you like, you do. You will have options. Chalo, next question, please. Second bit. If after 2 additional years, already 2 years over, now another 2 years are also over. So total how many years are over? 4. The remaining is 6 years. The interest on comparable bonds is 7%. Oh, today RR is 7%. What should be the price of each bond? Hello, sir. Second bit. After 4 years, required return is now 7%. Remaining life of the bonds is equal to 6 years. Sir, bond price ki you have to take future cash flows. Future cash flow means remaining maturity, not original maturity. From wherever you stand, future cash flows discount. Past cash flows, how can you discount into today's value? Future cash flows only you have to discount. Chalo. Series X bond. Is equal to, this fellow's coupon is 800 into PVIFA 7% up to 6 years plus 10,000 into PVIF 7% 6th period, which is 800 into first write PV factor, then GT it 4.7665. Tell me, sir, bond will be trading at par premium discount. Don't solve and tell. Don't solve and tell. Without solving, tell. Bond will be trading at par premium discount. What's the coupon rate? 8. Required return? 7. So coupon rate is more than your required return. Bond will be trading at premium to the par value. What happened now? Okay. 10,447 is what I got. You also should get the same number here. 476 you got. Why did you get differently? I wrote something wrong, huh? 666? 66634, oh, I'm sorry. Then it will be 6663. Okay, sir. Sir, if you spot that kind of mistakes, no, you should tell me spot immediately. You're not motivated, I'll give you some prize also for that, for identifying errors. Spelling mistakes I will not give. Okay. Series Y bond. What's the coupon rate? Is equal to required return is equal to 7%. Price of the bond is equal to 10,000 face value into 7% coupon rate into PVIFA 7% up to 6 years plus 10,000 into PVIF 7% 6th period 700 into 4.7665 plus 10,000 into 0.6663. See, in case we know the answer, but still naturally whatever comes, write that. Third question, he is asking, what is the conclusions you draw from the price of each of the bonds computed above? What conclusion did you draw from this? One conclusion is very clear about series Y bond. What is that conclusion? A series Y bond ka coupon rate always will be equal to required return, and therefore that bond always trades at par value only. So series Y bond ka conclusion is over. What about series X? Series X bond ka coupon rate is fixed. It won't change. Since it won't change, market level required return changes, e bond price also will change. Either it will be trading at par, premium or discount depending on what is the required return in the market. So, right, sir. Conclusion. Series Y bond always trades at par value as its coupon rate is equal to required return or yield always. Series X bond X bonds price fluctuates depending on the required return market. If required return increases, what will happen to bond price? If required return increases, what will happen to bond price? Bond price will rise or fall? Okay. If required return falls, bond price will rise. Sir, you should have multiple comfort zones here. Why bond price will fall when required return rises? For that, when required return increases, existing investor will not like the bond. He will try to sell the bond. Nobody will buy the bond, and therefore he has to sell the bond at a lower price. Somebody who buys the bond at lower price, he will be able to get his revised required return. Therefore, bond price falls. This is bigger logic, small logic. Required return is discounting rate. When you increase the discounting rate, present value will decrease. Any which way, mathematically, conceptually, somehow we remember this. So this only is actually my next concept. Relation between bond price and discounting rate. Bond price and discounting rate are inversely proportional. Required return, yield, discounting rate, whatever name you want to give, you give. If it increases, discounting rate, if you increase, present value will decrease. Discounting means deducting, and a meaning I told you while doing time value of money concept. So if you decrease more, obviously price of the bond will fall down today. If required return decreases, then bond price will increase. Inverse relationship they will enjoy. Next. Key point, yesterday I told you this. If the future cash flows of the bond are discounted with the required return, then the result is called as fair price of the bond or fair value of the bond. If the future cash flows of the bond are discounted with actual return, which is called as yield to maturity, then the result also will represent the actual market price of the bond. It is already concluded discussion only yesterday. Okay, let's see what other questions are there. If nothing is there, we'll move on to next concept. Okay. This is all. Come to ninth question. Ninth question also you can do, but that is okay. Go through it. Not do it. We'll go through and finish it off. IBA Bank had issued a tax-saving bond carrying an interest rate of 8% on face value of rupees 10,000 rupees per bond with 6 years to maturity and interest payable each year. Well, 10,000 rupees face value, coupon rate is 8%, 6 years life. Who is VV Finance? Change the name. IBA Bank. Okay, wait, no. It's a different company. I'm sorry. VV Finance had also issued a tax-saving bond of 10,000 rupees each with 8 years to maturity, carrying a coupon rate of 6%. Okay, fine. So two different companies issued two different bonds. Okay, but maturity periods are different. Here it is 6 years. Here it is 8 years. Here coupon is 8. Here coupon is 6. Face value alone is same. Today, that is after 2 years from the issue date. Okay. When a new bond with 6 years to maturity carries a coupon rate of 7%, this is your required return today. And a bond with 8 years maturity carries a coupon rate of 5%, means is required return today for the second bond. And both these bonds are priced correctly. Okay. Which is cheaper to buy and how many bonds can be bought for 5 lakh rupees? Assume part of a bond also can be bought. First of all, sir, if you think too much, you will get confused. Focus only on first bond first. First bond ka life was how much originally? 6 years. 6 years to maturity. And second bond has a life of 8 years. And out of the maturity period, few years are already completed. How many years are over? 2 years are already over. Today, what is the latest required return given? 7 and 5 for each of the bond respectively. He is asking, the bonds are priced correctly. So there is no overpricing, underpricing kind of scenarios. Both the bonds are equally good. You can buy any bond. But between these two, which bond should I buy is what he is asking, based on which one is cheaper. Cheaper means what? Whose price is lower, a bond you have to buy. That's the answer. Between these two, which bond is costing me cheap? How will I know? I have to compute the bond price, no? So compute what is there. Tell me, sir. Come to first bond. First bond ka remaining maturity is how much? 6 years original. Now 2 years is over, no? So remaining maturity here is 4 years. Second bond, original maturity was 8. Out of the 2 is over. Remaining maturity is 6. You have to always consider only the remaining maturity period, not the original maturity period. Original maturity period is computed when you are standing on first day issue date price. If you are computing, then original maturity date. If you are standing in the middle of the bond life, then remaining maturity life. Clear? Future cash flows means from today, whatever is going to come that. Okay, what you have to do now? Here 4 years ka coupons, here 6 years ka coupons, discount it. Maturity value also discount it. With discounting rates given already to you. For the first bond you will apply 7%, second bond you will apply 5%. Revised required returns. Shall work out the price of the bond. When you work out, you are getting 10,340, 10,506. Between these two, which one is cheaper is what he is asking. Between two companies' bonds, which one is cheaper? First one, 10,340. So go and buy that bond. This is not decision making question. This is not whether bond is correctly priced, underpriced, overpriced. It is not that kind of question. Bond is correctly priced in question only they are telling. So that is never your problem. Between these two companies, which bond is available at a cheaper price? First company ka bond. So he is asking how many bonds can you buy with an amount of 5 lakh rupees. Take 5 lakh rupees on your calculator ma and divide with 10,340. 48.351. That's all. Cheap question only, but exam range question only. Sir, our exam cheap questions are coming. Yes, sir. What can I do for that? Sir, you learn so much. But just because you know so much, high level question need not come. Exam, sir, do you guess how many marks this question can come? Yes. Yeah. 7 marks minimum it will come. All you have to do is this. One line, one bond ka price, another line, another bond ka price. Whichever is cheaper. Take that bond ka price, 5 lakhs, so divide it, get the answer. Over 7 marks. You understand, sir? Concept clarity should be there. Nice. Move on. Next. Yield came off. Nice. Okay. Next concept, sir. Sir, till now you are working out price of the bond. From here after you will see in almost all the questions price they will only give you. Sir, price they only gives us what will we compute? Yield. You have to compute the return. So here onwards the concept is yield calculation. Now what is the meaning of the word, plain meaning of the word yield? Now the word yield means it is a return expressed in percentage terms. Return expressed in percentage terms is called as yield. Now, if there is only one kind of yield, life would have been simple. But you have multiple yields in a bond. First one is called as current yield. Second one is called as holding period return. Third one is called as yield to maturity. Fourth one is called as yield to call. Fifth one is called as yield to put. One by one we have to cover. And among all this fellow is a hero. It means, sir, These are all side characters. You have to learn everything. Questions will come on this cheap sum also. Anyway, before we go further, write one small thing here. Simple. Is it difficult, sir? Simple means not that simple. It's simple written. This is simple and it can be compounded also. Current yield is a simple return, sir. Holding period both are possible. Last three are definitely compounded returns. Compounded return means time value of money you have to consider and play. Reinvestment, return on income, everything is there in this. Let's start with the first one, easiest one. Current yield is equal to coupon amount in next 12 months divided by market price of the bond into 100. Coupon amount in the next 12 months divided by price of the bond into 100. This technique computes yield earned only in the form of coupons, and it ignores time value of money. It is very important to know that current yield is a simple return and it considers only a span of 1 year. We consider a time frame of only 1 year. Sir, there is a 4-year-old bond, 4-year maturity bond. The bond cash flows are like this. You will get 100 here, 100 here, 100 here, and here. And here you will get 1000 maturity value also. Today, price of the bond is 980. One year is over. After 1 year, price of the bond is 1020. My question is very simple to you. In the first 1 year, how much return did you earn? On your calculator. How much return did you earn in the first 1 year? I will not give you any formula and all. Just try on your own and tell me the return. Only 1 year. 100 rupees is definitely your return. Plus 980 you purchase the bond, it became how much? 1020. There is an increase of how much? 40. That is also return only, no? So 100 plus 40 divided by your initial investment is how much? 980 into 100. 14 to 8. Ideally, this should be the return. Okay, ma'am? But current yield ignores capital gains. It considers only coupon rate, coupon amount only. So what I should remove now? The answer is 100 by 980 into 100. That's the current yield. So, current yield technique is 100 divided by 980 into 100. 10.20%. So guys, this is that. Next. In this only another example, watch this. Zero. Bond market price today, let's say, is 100. At 6 months time, it pays a coupon of let's say 8 rupees. At 12 months time, it pays again a coupon of 8 rupees. And life is, it goes on. Current yield is equal to, denominator is fine, market price 100. Percentage I want, so answer is again multiply with 100. Numerator what I should take? 8 plus 8 or 8 plus present value of 8 or present value of 2 8s. First and foremost, forget about discounting. There is no time value of money concept here. The next question is, should I this is semi-annual bond apparently, so you will still have to consider full 1 year. So numerator will be 8 plus 8. Answer is, sir, what each technique is trying to tell you that you should have clarity. Current yield technique considers return earned only in the form of coupons for the next 1 year only. So answer is how much? 16%. That's all. This is the current yield story. On these questions are there, we will do a cheap question. This I will not make you do immediately and insult you. We will go to the next concept. Who's this next technique, sir, in the order? Holding period return. Okay. Holding period return. It computes return from date of purchase of bond till the date of sale of the bond. HPR can be computed in simple return terms or in compounded terms. The question will tell you which one you have to do, sir. Nothing is given. Generally, we prefer simple terms. Now, so there is a bond which is paying a coupons of 80 every year, like that for a period of 5 years. What our investor did is, here he bought the bond at rupees 950 and here sold the bond at rupees 1000. So even though the maturity period is 5 years, this fellow held the bond only for a period of 3 years. So if you compute return from first year, second year, third year combined, that is called as holding period return, from the date of purchase to date of sale. Now, holding period return, simple terms, the time value of money we ignore, is total coupons received plus sale value minus purchase price, you can say, initial investment, you can say, whatever you want. Divided by initial investment into 100. So total coupon received in 3 years is how much? 80 plus 80 plus 80. You observe first 80 first year, second 80 second year, third 80 third year. They are standing at different points of time, but we ignore time value of money under simple return, so I directly add them. Plus sale value 1000. Initial investment 950. 50 rupees capital gain is also there. Divided by my initial investment is 950 into 100. This is your holding period return ka answer. Tell me one small thing. This 30.53% is for all 3 years put together, only for 1 year, ante each year. 3 years combined or per annum? Combined or per annum? Combined. How do you know that? Look at the numerator. You clubbed 1 year ka interest or 3 years ka interest? 3 years ka interest. Capital gain you earned in 1 year over a period of 3 years, over a period of 3 years. So numerator lo whatever return amount you wrote, our return amount is for 3 years ka return, combined return. Therefore the percentage also is combined return. So this is your HPR for 3 years. HPR per annum. This nobody will ask you, sir, but as such, if somebody asks you, then you just proportionately calculate it. How to compute proportionately? 30.53% is for how many years? 3 years. Divide by 3, multiply with 1. 17 or 18? 18. Well, this is how you do holding period return. Now, holding period return compounded is similar to YTM. So similar to YTM means how will we know now? You will not know, simple. We'll work out YTM. Once you understand how to compute YTM, holding period return, compounded terms, automatically you will know. If I discuss of holding period and compounded terms now only, then YTM there won't be anything left to discuss. The small cute concepts are YTM we cover, then we'll come back and discuss again if you want. Okay. Now, on this some small cheap questions are there. Finish it off fast. Respect your study material. Question number 11. Do first one. Face value of the bond is 1000. Fantastic. Coupon rate is 6%. Okay. Current market price is 900. Current yield he is asking. Current yield formula is what? Coupon amount divided by market price. Coupon amount is how much? 60. Market price is how much? 900 into 100. 6.67. Come here. A 13% bond, interest payable annually, is issued at 100. Okay. Issue price irrelevant for you. Its market price is 112. Issued at the 100, and why he is telling you is indirectly, generally bonds are issued at par value only, no. So he is indirectly telling you that this is the par value. Market price today is 112. Bond yield ki we don't want par value, we want only price, because investment will happen at price of the bond. Calculate the current yield if it matures in 5 years. Let it mature in 55 years also. Current yield will consider only a time frame of next to 1 year from wherever you are standing. Formula is what? Coupon amount. Coupon amount is how much? 100 into 13%. 13 rupees divided by 112 into 100. That's 11.60. Well, next one. Also calculate current yield if it is semi-annual bond. If it is semi-annual bond, you won't get 13 rupees. You will get 6.5, 6.5. But still, I ignore time value of money. So still I will go and club 6.5 plus 6.5. Again, my answer will be same. Clear, sir? Next, come here. Are a question solved in your notes? Something you should have, no? Otherwise, it look like I'm solving everything in air. Read. A had purchased a bond at a price of 800 rupees with a coupon payment of 150 rupees and sold for 1000 rupees. Oh, 800 you bought, 1000 you sold. Ee gap lo 150 rupees coupon you got. He is asking what is your holding period return. In your notes, sir, please write the answer. Formula not required. Directly answer you write. Holding period return is equal to, tell me, sir, what is the coupon you received? 150 rupees plus sale price 1000 minus 800, the capital gain. It abides capital gain. Whole divided by, what is your initial investment? 800 into 100. Well. How much? 43.75%. Well, next one. If the bond is sold for 750 rupees, after receiving 150 rupees as coupon payment, what is the holding period return? So he's now changing the sale price. Instead of you selling it for 1000, you sold it only for 750. So it will be 150 plus 750 minus 800. What is happening? 150 rupees coupons you received, or 50 rupees capital loss you suffered. Net return is only 100 rupees for you on your investment of 800. 100 by 800 into 100, 12.5%. This is study mat question, cheap one. You insult yourself. Kanna purchased 1000 rupees par value bond for 950. Coupon payment is 90 rupees. 1 year later, he sells the bond for 900. Find out his rate of return. Can we handle this? Okay. Hereafter, the story of YTMs. Okay, guys. Now that we are done with current yield and holding period return, now coming to the main technique, which is called as yield to maturity. Now first understand the characteristics of yield to maturity, then we will do the question. Sir, in a very simple terms, if I should explain yield to maturity, this is nothing but IRR. Okay, now formal definition is, it is a return earned by investor if he holds the bond till maturity date. If you hold the bond till the maturity date, overall return earned by the investor is called as YTM. It's measured in compounded terms. So broadly what will happen is, Let's say there is a 5 years bond. This is your initial investment. Your initial investment is price of the bond. Future cash flows are coupons. Plus also maturity value. So these are all your future cash inflows. Now, what is IRR is, what is IRR discussion, sir? What did we learn? IRR is that discounting rate which equates the present value of future cash inflows to present value of future cash outflows. Here, what is the future cash outflow? Sorry, present value of outflow is what? Price of the bond. Future cash inflows are what? Coupons and maturity value. So your job here is to work out a discounting rate at what discounting rate this present value will be equal to price of the bond. That discounting rate, if you identify, that we call it as yield to maturity. This discounting rate at which PV of cash inflows will be equal to PV of cash outflows. The discounting rate which equates coupon payments and maturity value to the price of the bond today, that rate is called as VATM. Now, how will we work out this rate? How did we learn this? When, see, if there is a single point inflow, single point outflow, we have a shortcut formula. This is not that, because there are multiple cash flows in future. So you can't apply square root of inflow by outflow minus 1. Our formula will not work. So you have only one option, trial and error. So to be computed using trial and error approach. What is the meaning of trial and error approach? First, randomly we try at some rate. We will see whether it is matching or not. If it is matching, luckily, that's all. That is your ITM. If it doesn't match, try at some other rate. Try at some other rate. Go to that kind of iterations where one present value will be higher than the price of the bond, one will be lower than the price of the bond. Then you sit and interpolate that. Just like how you computed IRR, same style you got to do this one also. But having said that, there is a small shortcut for you. Approximate YTM can be calculated using following formula. A trial rate where to start with. For that, there is one small technique. It's called as approximate YTM. Now, approximate YTM formula is this. Take the coupon amount, to that coupon amount add maturity value minus spot price of the bond divided by life of the bond, whole divided by spot price plus maturity value divided by 2 into 100. This is one model of working out approximate YTM answer. There is one more formula that also you can use. Slightly different answer you will get. In fact, the second formula is more appropriate than the first one. But most of the books, the first one is used. But CMS Study Matter, they have used both the formulas. Second formula is more convenient actually. Maturity value minus spot price divided by life of the bond, whole divided by 0.6 into spot price plus 0.4 into maturity value. into 100. So between these two, which formula to be used? Remember, both the formulas will not give you same answer. There will be different answers, but remember, both are approximate VATIMs. They are not correct VATIMs. Correct VATIM, if you want, you take a clue from this and do 1 or 2 trials and then go and interpolate it. Work out proper IRR. That's how you work out correct VATIM. But I checked all your study material. 99.99% of the questions, wherever they ask you to compute VATIM, they are leaving the solution just by doing this. Nobody is computing entire full trial and error VATIM. So you take a call looking at the how many marks it's awarded for. If it's a 4 marks, 2 marks kind of question, this would suffice. If 6 marks or something like that, then you work out trials and all. I will do both for you. In few questions we'll solve everything and then after we'll settle down with this. Right? So this is how we handle it, sir. E formula is important. Now E formula ka logic is what? No big logic, sir. Watch this. This is coupon amount. Every year cash inflow. What is this numerator here? A double numerator. Maturity value minus spot price ka meaning is what? I purchase the bond, let's say 950 rupees. Maturity value is 1000 rupees. How much capital gain? 50 rupees over a period of 5 years. And the per annum capital gain is how much? 10 rupees. So this is per annum capital gain. This is per annum coupon amount. Numerator is what? Per annum written in amount terms divided by your initial investment. Actually invested what? Spot price. But instead of taking spot price, we take an average of spot price and maturity value. This is simple average. This is weighted average. By taking divided by 2 means what, sir? You are multiplying this also with 0.5. This also you are multiplying with 0.5. If you multiply this with 0.6 and 0.4, this is second formula. That's all. There is no difference between first formula and second formula except the denominator. Let me tell you, both are wrong answers only. They are not 100% accurate VATIMs. But a second answer will be very near to your actual VATIM. That we will prove and I'll show it to you. Let's pick up a question for that. Question number 11 you take. If the market price of the bond is 95, years to maturity is 6 years, coupon rate is 13% per annum paid annually, and issued price is 100. Issued price and a word ke earlier also I told you the meaning. This is nothing but face value. Because generally bonds are issued at face value, that's why he is calling it as issued price. Issued in past tense, once upon a time issued. Today market price is 95. He is asking what is the yield to maturity. So let's solve this, sir. Question number 11. All this is not required. Approximate VATIM is equal to coupon amount. Coupon amount 100 rupees into 13%. Just 13 plus maturity, nothing is given, par value minus market price today 95 divided by life of the bond 6 years, whole divided by. In the first formula take simple average, second formula take weighted average. Both will give you nearly correct answers only. I am taking simple average first. 0.5 into 95 plus 0.5 into 100 into 100. Carefully solve this. So that is 5 divided by 6 plus 13. How much are you having? 14.188. 88%. Sir, this per annum, let's say entire 5 years ka, or entire 6 years ka, per annum. How do you know it's per annum? Because numerator lo we took return of only 1 year. Earlier holding period return when we did, entire 3 years ka returns we took. Therefore, it's a cumulative return. This is per annum return. Okay. So this is first formula. Do the other version also. Thirteen plus 100 minus 95 by 6. 0.6 into 95 plus 0.4 into 100 into 100. That's 13.833 divided by 97 into 100. Okay. 14.26%. Observe this. This and this is not same, but that is near only, no? One is 14.19%, the other one is 14.26%, 0.07% difference. Both are approximate answers only. So if you want the correct answer, what I will do, I'll have to do trial and error. So correct accurate YTM. Trial 1. Let me check what I wrote in the notes. Okay. Fine. Trial 1. Discount bond cash flows at the rate of 14.26%. What's the life of the bond given? 6 years. Every year 13 rupees cash flow, last 100 will come. 1 divided by 1.1426. 1, 2, 3, 4, 5, 6. 0.4494. 8611, sorry. Sir, I got PV of cash inflows is equal to 95.13. What is the actual market price of the bond? This is the question. 95. How much did I get? 95.13. Almost it is 95 only, no? You can say that this is almost equal to current market price of the bond, and therefore this is your final IRR. You can close like that. But I don't want to close. I want accurate answer. So this is not equal to current market price of rupees 95. You tell me, sir, even after discounting with 14.26% also, the number is not coming to 95. It's still standing at 95.13. Tell me, the IRR is higher than 14.26, lower? Higher or lower? Higher. You want the present value to reduce. So discounting rate has to increase. So let's try at some other rate. Bond cash flows at 14.5%. I'm trying. If you try with 14.5%, How much is this? 1 divided by 1.1450. 0.4438. If you check this, I am having 94.25. So here, this is lower than current market price of rupees 95. What it means is, from previous trial, we concluded that the bond gives a return more than 14.25%. Now I know that it is giving a return less than 14.5%. So your actual return is lying between what and what? Between 14.26 and 14.5. You have to just interpolate and get the answer. That's it. Over. Tell me, sir. At 14.26%, PV of cash inflows was 95.13. You can be happy with that only, actually. That's very small error, but that's okay. We'll do it. 14.50%. PV of cash inflows is 94.25. So what you have to observe is, when I increased the discounting rate by 0.24%, PV of cash inflows will definitely decrease, of course. Decreased by 95.13 minus 94.25, 0.88 rupees. How much decrease do I want? For a decrease of 0.13 rupees, this should increase by how much? Cross multiply. Careful while doing this. Don't apply the percentage symbol. This symbol, just write like that. Don't apply. 0.24 into 0.13 divided by 0.88. 0.03545 percentage. Sir, this percentage. My final answer should be in percentage. So don't apply this on this. If you apply it again, it will become double decimal. Sir, you have to again convert. Don't apply. Directly simply multiply and leave it. So tell me, sir, what is your YTM now? What is the meaning of this? This much increase you want. So YTM is equal to 14.26 plus 0.03545. Yeah, 14.2955 or 35. Roughly 14.30. What is that? This is your accurate, correct YTM, sir. The perfect answer, this one is. From this, what is the proof is, both the approximate YTMs are wrong. But the second one is almost near. First one answer is how much, ma? 14.18. This is 14.26. Actually is how much? 14.30. Which one is near? Second formula. So if the question asks you YTM for a 3 marks or a 4 marks, don't solve all this. Just write the second formula and you stop your answer here. Over. Clear, sir? Sir, anyway, when we are going to stop here only, why to discuss this entire thing? Some questions now they have asked specifically that you have to do the entire YTM. So we need to know, but see, sir, in any question, if you solve this part, you will invest extra 5 minutes and solve. That is not wrong. No, this is still okay. This is 100% right, in fact. The question expects only this much. Do only this much and leave. Chalo, move on to the next question. Tax effect. Tax effect we will do in some time. 1 second. Please come here. Question number 16, please. Question number 16. A AAA rated bond of face value 1000 is currently quoting in the market at 1062. Market price is given to you. The coupon rate of the bond is 14%, but it is payable semi-annually. Okay, nice. The remaining maturity of the bond is 5 years. Fine. 5 years means how many coupon payments are there? Semi-annual bond, 10. And the principal is repayable in 2 equal installments at the end of 4th year and 5th year from now. That means your maturity value, maturity amount is not given at the end. It is given in 4th year and 5th year. Continue. Find out the YTM of the bond. Now, is one small problem we are facing now. What is that problem? Maturity value is not coming at the end of the 5th year. It is coming partly in 4th year and partly in 5th year. Because of that, what problem I will face now is, it is difficult to at the end of 4th year and 5th year from now. Correct. So with this, what is the problem we will face is, since your cash flows are not falling in this kind of pattern, this formula will not work. This formula will work only when the cash flows pattern is like this. Maturity is payable at the end. Then only this will work. If maturity is coming in between only, then that will not work. So, then how to do? How to do? You don't have a choice now. You have to do literal pure trial and error. That's the reason interpolation you have to learn. Okay. So, start, sir. What is the question number, sir? 16. Okay. Right, sir. Bond life is 5 years. Semi-annual bond. Therefore, 10 periods of 6 months each. 10 periods of 6 months each. Now, let's do one thing. Period. Cash inflows. Sir, since 5-year bond, so total 10 periods are there. Your coupon rate is given as how much more? 14%. 14%. So since it's a half-yearly bond, you have to consider only 7%. On your face value of how much? 1000. Now, carefully observe. First year, you will pay, first year, second year, third year, fourth year, fifth year. In this, up to 4 years, there is no problem. But fourth year ending, sir, a portion of principal is getting repaid. Now that a portion of principal is getting repaid, in the 5th year, the 2 interests, whatever you are going to receive, the 2 interests will be computed only on the remaining principal amount. What is the face value of the bond? 1,000 lesser 500 you will get at the end of 4th year. Another 500 you will get at the end of 5th year. So, throughout first year, second year, third year, fourth year, you will get coupon calculations on 1000. But in the last 1 year, coupon calculations will be made only on 500 rupees because 500 is already paid. Are you able to spot this? If you spot this, half of the job done now. Now what you have to do is, watch this first, at once you can write. I'm writing 1 to 8. 1 to 8 means end of which year? Good. Up to end of year 4. Your coupon amounts are 1000 into 7%, which is equal to 770. Next. 8th year ending, you are having a principal payment, 500. This is how much? 1000 la half 50%. Then 9 and 10, you will have payments of 500 into 7%, which is how much, sir? 35, correct. 10th period la you will get another 500. Sir, all of you, did you understand the calculation of cash flows there? Cash flows, if you get discounting rate, if not 2 trials, 5 trials, I will do, somehow I will get it. Cash flows mistake is there, the entire effort is wasted. Okay, first the semi-annual bond and principal payment is happening twice, not at the end. That's the reason shortcut formula cannot be applied. A note I will make you write later on. Now, a question about data is given. Fine. So this fellow, look at the price. Market price he gave you. What is the market price given? 1062. Tell me, sir, bond trading at 1062 means it is trading at par, premium, or discount? Face value is how much? Market bond price is how much? 1062. So I'm not asking for decision making. Ignore decision making. Nobody is asking you to make a decision. Simply compare with face value. Tell me bond is trading at par, premium, discount? Premium. Now carefully answer my question. When will bond trade at premium? Actual price is more than face value. That is visible there. Okay, that's okay. But which scenario it will trade at premium? Required return is less than the coupon rate. Correct? What is the coupon rate? So per period it is 7%. So your required return or your yield rate is less than that. Since it is less than that, only bond will be trading at premium. You understand, sir, why we discussed that concept? A concept is not for decision making. It's for catching where the YTM is standing. Bond is trading at premium. Bond trades at premium only in the third case. Third case is which case? Your required return is less and coupon rate is higher. So coupon rate is 7. So required return should be something less than 7. Otherwise a bond will never trade at premium. Sir, less than 7 how much? I do not know. What will I do? Trial. So do one try. 6% give try. A study mat answer, sir, that fellow directly took 6% iteration and tried off. 6% logic is what? Illogic. Illogic, if you have to learn, entire knowledge you should have. Bond trading at premium means the coupon rate is higher than the required return. And therefore, if you want to catch your required return or the YTM, you have to go below the coupon rate. Coupon rate is 7% effectively now. So go below 7%. That's the reason. Okay, ma? So try. So PV factors at 6%. PV of cash flows. Definitely I will fail here. Then PV factors at 7%. Here also I will fail. And then I will interpolate. Carefully write the table till now and slowly work out the annuity factors, PV factors, mid annuity factors, all this work out. All the investment in time value of money, full paisa vasool ee chapter. Can you tell me this one? 9 and 10 annuity factor. 9 and 10 annuity factor, how to work out? Work out 9th year PV factor, M plus it. Work out 10th year PV factor, M plus it and MRC. That is coming down to 1 point. You are making me doubt my calculator. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 1.1503. Slowly work out this. Don't fill up individual numbers. Directly do it. Trial anyway. That's not correct answer also. 70 into 6.2098. 500 into 0.6274. 35 into 1.1503. How much are you having? 10? 84585 I'm taking. What is the actual market price given? Question. 1062. YTM is greater than 6%. Your return is more than 6%. Because if you work out the NPV now, the PV of cash inflow, PV of cash outflow, NPV is positive. If NPV is positive, what does it indicate? Your IRR is more than your discounting rate. So you have to try something more than 6%. You can do it 6.5% also actually. There is no need for you to go up to 7% also. You can try it 6.5 for a more accurate answer. So I'm changing it. Sorry, I wrote 7 originally. I'm changing it to 6.5%. One divided by 1.065. 1, 2, 3, 4, 5, 6, 7, 8. But these are half yearly payments. No one I'm getting doubt. That's okay. It is 6.08875 is 8 only. Okay. Then 1 divided by 1.065. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 0.5327. 1.10. Perfect. Total it up. And pray to God that this should go below 1062. It went 1033.17. So your PV of cash inflows now went lower than actual market price of 1062. What is the proof? What is the conclusion of this? Therefore, YTM is less than 7%. So from this, not 7, 6.5. So from this, the conclusion is your YTM lies between what and what? 6 and 6.5. You just have to interpolate and get the answer. That's it. At 6%, PV of cash inflows was 1067.85. At 6.5%, PV of cash inflows is 1033.17. For an increase of 0.5%, we observed a decrease in PV of cash inflows. $34.68. 34.68 rupees fallen down. How much do I want? Desired decrease in PV of cash inflows. is 1067.85 should come down to 1062. So all I want is only a change of 5.85 rupees. So here how much should I increase? Is equal to cross multiply 0.5 into 5.85 divided by 34.68. 0.084%. Cross multiplication simply. Don't apply the percentage directly there. Percentage treat as a symbol and write there. Therefore, finally, your YTM is equal to 6 plus 0.084. 6.084%. This is your final answer. The answer printed there will be slightly different because they interpolated 6 and 7. What did I tell you? If the gap is large, the answer will be less accurate. For interpolations, gap should be as small as possible. We took a gap of 0.5. That fellow took a gap of 1%. His answer will be slightly different, but our answer is obviously more right. Of course, you should not forget that this is YTM for 6 months period. Annualize it. Annualized YTM is equal to 6.084 is for 6 months. How much is it for 12 months? 12.168. That's it. You see here, this is a proper accurate YTM. In this, there is no approximate formula and all. It's all in the time value of money, sir. How detailedly, properly you learn there, things will become so smooth. If you understand now, it's as good as you know it. Only thing is you have to practice it. But understanding ki blood is time value of money. Okay. Now, a couple of note points you write here. It will be safe for you. Later on, it will be easy for you to understand. Note point 1. Coupons up to 8th period is equal to 1000 into 14% into 6 by 12, which is equal to 70. At end of 8th period, which is nothing but 4th year, repayment of rupees 500. Therefore, coupons in 9th and 10th period will be, out of the total face value 1000, 500 is repaid. On the remainder 500, 14% 6 by 12. That is equal to rupees 35. Note point 2. Since the maturity value is not repaid in lump sum at the end of year 5, but partly in year 4 and partly in year 5, we did not apply approximate YTM formula. Guess what? If you apply approximate YTM formula also, you will almost get the same answer. It won't cheat you here. Only thing is, it won't be as accurate as you got previously. But you'll get confused because there is no one coupon. Out of 10 periods, 8 periods ke coupon is 70 rupees, 2 periods ke coupon is 35. You have to mix everything and take average coupon there instead of coupon per annum. So why to create a new formula and all? Anyway, that's an approximate answer. So I worked out the entire thing, which is how they have also worked out. The major note point what I want to make you write is this one. For each 6 months, the bond pays a coupon of 7%. The bond is trading at premium. The bond is trading at premium. It means that the required return oblique YTM, they both are same now. When bond is correctly priced, everything is same, is less than the coupon rate. Therefore, our first trial was at 6%. Sir, in this note point 2 and note point 3 are not for exam purposes. That's for inside. For your understanding, I made you write. Don't write all these in exam. Nobody wants to know your feelings. Answer is enough. Sir, these are all looking good now, but after you become more comfortable with all these concepts, they look very silly. I wrote this also and a feeling will come. It has to come ideally. Okay, so it's time value of money, sir. Just you are still learning. Nothing wrong. Slowly accumulate. Next question. Peeps wrote, all of you? 16th one is sorted. Now, I'll show you. See, this is heights. Your study material went one notch up higher. Read this. ABC has provided following information. What information? Annual interest payment is 60. Par value of the bond is 995. Okay, what is that stupid number? We don't know. Current market price is 700. Years to maturity, 5 years. Find out YTM. Now the question asks you YTM, you have to work out YTM and give no. What that fellow did you see? Excel sheet la formula he applied, it seems. Not my answer. Study mat answer. I just simply copied from there. 14.68. Excel sheet exam lo nobody will give you no. So shortcut formula. I plus F minus P divided by N divided by 0.4 plus 0.6. What is this? Approximate YTM formula 2. If you apply that, you got 14.54. This is not accurate, but this is almost near to the correct YTM. Are you understanding, sir, what is happening there? Till now in the questions, 2 questions what we solved, we worked out approximate also, full also. This fellow worked out full using Excel sheet. We don't need Excel sheet. We can also work out with calculator and normal pen. That fellow, he does not know. You can handle this one. I'm leaving it. Simply same. Come to 11th question again. 11th question, when we sorted, we ultimately decided that the YTM is something around 14.29% or 14.3%. Next question, continuation is there. Read this. Considering the information from the above question, calculate the after tax YTM to the investor if the tax rate is 30% on the coupon payments and capital gains. Look at this, sir. Suppose an investor who buys this bond will end up getting a return of 14.295% return he will get. But on the return, our auntie will take tax also, no? Tax you have to pay. After paying tax, he will not have 14.295%. No, out of the 30%, she will eat off. Now, in our entire calculations here, did I anywhere consider tax? No. But now the question is, please give me after tax YTM. Sir, it is like this, sir. Forget about this sum. Normally, you think you are earning a return of 20%. That lady wants 30% out of whatever you earn. So how much are you earning net? 20 I am earning, sir. 30 if I pay off, minus 10. Your 20% you are earning on your investment. 30% she will take on what you are earning. Correct? So 20 as a whole number minus 30%. How much is that? 14. So 14 is your after tax return. Correct? Like that only. If 14.295%, if it is your gross return, on that if you pay a tax of 30%, take your calculator, 14.295 minus 30% directly. 10.0065%. This is after tax return. Clear here? Now, my point is this. If 14.295%, this return, whatever is there, are the coupons ka return, capital gain ka return, both? Both. Proof. You see here. This is coupon, this is capital gain. Both are included as a part of your YTM calculation, isn't it? But luckily, in this question, that fellow told that normal coupons and capital gains both are charged at 30%. Therefore, what we can do, take the overall YTM without tax and straight minus 30%. But you are all pro in tax. In tax, what did you learn? Capital gains tax rate is different. Income from other sources, interest income ka rate is normal tax rate, adi different. They both are not same. If some simply assumed they are same. Next sum, reality hit. Come. There is a 9% 5-year bond issue in the market. The issue price is 90 and the redemption price is 105. Okay, bond is now only just now issued. E bond ka price is 90 now. Redemption price, maturity value is 105. For investor with a marginal income tax rate of 30% and a capital gains tax rate of 10%, assuming no indexation, that is also there. You have to do tax chapter now. What is the post-tax yield to maturity? Requirement is same. I want after-tax YTM. But twist is, your tax rates are not same. On interest income, it is 30%. On capital gains, it is something else. Tell me, sir, can I do this kind of adjustment now? Directly work, first forget tax, work out on YTM. From that YTM, directly remove tax rate. Can I do like that? I can't. Em chedamantavu? Sir. Good. What you do is, since you directly cannot disturb the rate, YTM rate with the tax effect, what you do, disturb the cash flows itself. Disturb the cash flow ka meaning is, this YTM formula is there, no? Instead of taking coupon amount gross, take coupon amount net of tax. Then your cash flow automatically reduced, no? Similarly, instead of taking maturity value, take maturity value net of capital gains tax. That way what is happening? You are reducing your cash flows that are going into computation of YTM. Thereby directly after tax YTM you will get. Sir, directly rate I cannot disturb with tax rate because my YTM rate includes coupon amount also, capital gains also. If both are taxed at the same rate, then I can disturb like this. But when they both are taxed differently, I can't disturb the rate directly. Since you can't disturb the YTM rate, go and disturb the ingredients of YTM. Who are the ingredients of YTM? Cash flows. Cash flows disturb chesandi, sir. And work out YTM and leave it. That's all. So let's start. Question number 13. Coupons and capital gains are taxed differently. Therefore, we cannot adjust YTM rate directly with tax rate. So we adjust the cash flows for tax effects. Coupon amount each year. Check once the annual bond or semi-annual bond, sir? Annual bond only. So what's the face value? Face value not given, sir. Not given means you assume. Tell me, sir, bond ka market price is 90. Face value will be 1000. 10 rupees, sir. No, it will be around 100 rupees only. Okay, so question sometimes will not give like that. Is equal to 100 rupees into what's the coupon rate? 9 is equal to rupees 9 minus tax at the rate of 30%. That is rupees 6.30. Coupon amount net of tax. Next. Tell me, sir, what is your maturity value of the bond? Towards the end, they will redeem the bond at 105 less. Initial purchase price, which is 90 or 95? 90, okay. Which means the capital gain is rupees 15. Capital gain tax at the rate of 10% is rupees 1.50. Now tell me, what is the net amount? Okay. Look at this. If 105 rupees is inflow at year 5, if 1.5 is tax payment, outflow at year 5. Therefore, maturity value net of tax 103.5. 15 minus 1.5, we get tempted, all of us. That is wrong. What will I do with net capital gain? Useful or useless? Useless. Net inflow you want. That's all. You have what you want. Just work out approximate VALUATION formula and leave it. Coupon amount 6.3. Maturity value 103.5 minus spot price 90. Life 5 years or 6 years? 5 years divided by 0.6 into 90 plus 0.4 into 103.5. Entire thing into 100. Sort out this. If possible, sort out in single go. Direct answer. Everything should be on your calci. I got this check once. Solve this, put it in denominator. This one you solve. 9 into 0.654, that much we know. Adi m plus adjacent. So this will be in M plus. Solve this, add this, divided by MRC into 100. 9.43%. Well, okay. Next question. So tell me, whatever you computed is accurate VTM, approximate VTM? Approximate, and that is sufficient actually. You have seen just now ICMA question also where they left it there. He did Excel sheet this one, on paper this one, and he says it's okay. This is also similar one, sir. Look at this again. Company is offering a bond with a price of 100, coupon rate is 12%, maturity period 5 years, bond will be redeemed at par, and the investor faces a 30% tax on income and 10% capital gains tax. Find out the effective yield to maturity for the investor. Okay. Carefully observe. This sum is similar to previous sum only. Okay. Now, 30% tax on income and 10% capital gains tax. Carefully observe, sir. A bond is today issued at what price? And bond is also redeemed at par, which means what? 100, which means capital gain is? So capital gain tax is 0. Capital gain tax is 0. The only, your YTM now totally comprises only of coupons, and coupons are taxable at 30%. So normally work out YTM minus 30% you do. The answer will be ready. So if you work out that, it will come to something like this. 12 rupees coupon, sir, plus 100 minus 100 divided by 5. The entire dabba will burn to 0 divided by 0.6 into 100 plus 0.4 into 100 into 100. So that's exactly 12%. But it's before tax. If you want after tax YTM, so straight away take 12% minus 30%, or directly do like this, minus 1 minus 0.3. 8.4%. Sir, that fellow got 8.41 now, sir. Are sir, the accurate YTM. At Excel sheet he did. Solving, how did you solve? You have to explain, no. Study mat question, no. They have to teach, no student. Next, sum they taught using Excel. Excel, what is here, sir? All the cash flows, put it in one line. Put a formula like this, is equal to IRR, open bracket, select all the cash flows, enter. Tada, answer will be ready. But 5 marks will not be given for that. You need to know how to sort out. Okay. Achieve some. Okay. This we will solve later on. Come here, 19th one you solve. An investor is considering the purchase of the following bond. Considering purchase means he did not buy, he is thinking. Face value is 100, coupon rate is 11%, maturity is 3 years. If he wants a yield of 13%, what is the maximum price he should be ready to pay for? Tell me what is the question requirement? What is he asking? If he wants a yield, meaning what? What is the meaning of this? Good, very good. This is required return. If the question gives you required return, they are asking how much I should pay, means what is he asking? Fair value. Do all of you do. Table, formula, line, copy and write, somehow do. Get the fair value of the bond. What's the coupon amount? 11. What's the desired return? 13%. Sir, coupon rate 11%. What I want is 13%. Tell me, bond will trade it? Par premium discount. I want 11. Sorry, I want 13, but the bond gives only 11. My required return is higher than the coupon rate. So bond will be trading at discount to the par value. Adi, you should already know inside. You don't know how much price, but you should know that the answer will be less than par. Okay, 13%, how many years? 3 years. 100 into PVIF, 13%, third period. 11 into how much did you get? 90? 27 you got. I got 28. That's okay. Will not fight for chiller. 95.28 is the fair value of the bond. What is the meaning of this? If I want to earn a return of 13%, I should buy the bond at 95.28. Now read the question. Tell me what is the actual price of the bond. Actual market price of the bond is given. See. Second case given, sorry. If the bond is selling for 97.60. First of all, he did not ask, but you tell me. Fair value is 95.28. And I should buy the bond only by spending 95.28. If I am lucky, I will spend less than that. But actual price is 97. Is overpriced, correctly priced, underpriced? Overpriced bond, we should buy we should not buy we should not buy. The bond is overpriced. Therefore, do not buy the bond. If you buy the bond, what will happen? You won't get any return. You will get, but that return will be less than your required return. He is asking that. I want that. YTM. He is not asking decision. He is asking YTM. Okay. YTM of bond is equal to approximate weighting formula is enough. Coupon amount. What is the coupon amount? 11 plus maturity value 100 minus 97.6 divided by how many years, ma? 3 years divided by 0.6 into spot price 97.60 plus 0.40 into 100. $11.97%. What is my RR? RR required return 13. But if I buy this bond, how much will I get? 11.97. Should I buy this bond? You should not buy this bond, and I told you here already. If you don't listen, you still go and buy the bond. This is what will happen. Yesterday when we did the first question, what did I tell you? For everything there will be a proof. When we say don't buy, don't buy. If you buy, what will happen? You will get a return, but that will be less than your required return. The proof is what else you want? The full picture, sir. Yesterday's concepts, these concepts, all questions if you mix, you will ultimately stand that whatever fair value you are computing, if you are able to buy the bond at that rate only, then exactly you will earn your desired rate of return. If you pay more, you will earn less. If you pay less, you earn more. Are they underpricing, overpricing concept? He bond whether it trades at par premium discount, that depends on whether coupon rate and required return YTM are same or higher or lower depending on that. You just have to understand all this, practice, and then write everything once on your own. Then only you will get comfort. Sir, this and all will look confusing sometimes too easy. But it should stand the test of the time. After some months, if you open also, it should be able to be like, falling into the right place, right logics. Write in your own language, you write. Things will become deeper, sir. These are all just at surface level, you are there. But ఇది maximum, sir. I mean to say conceptually the maximum. These are all essential. Okay, next. What are we doing? YTM. Okay, fine. Another question we'll try. This is question number 19. Okay, cheap question, leave it. Now, come, 22nd one you come. This fellow is waiting for you. He answer whatever is printed here, no. It gave us 11.94%. That's because I applied the first formula. But in your study material and all, they are using second formula, and by experience also we know that second formula ka answer is more accurate than the first formula ka answer. So second formula you use and carry on. The first formula answer why I wrote is this CA final exam question, sir. Because CMA finals people are using second formula, that fellow did overaction and used first formula. So CA final ka question, so the answer is looking like that. Don't mind, you do your own version. Okay. Chalo, come to 22nd one. Based on credit rating of the bonds, Mr. Z has decided to apply the following discounting rates for valuing the bonds. Credit rating, if it is a AAA bond, high quality bond, then the discounting rate what he will expect is 364 days treasury bill rate plus 3% spread. Spread means difference. Spread and a word ki meaning is difference. What is T-bill? Treasury bill. Who issues treasury bill? RBI will issue treasury bills on behalf of Government of India. That is considered to be the most risk-free investment. So, our risk-free rate plus 3% extra I want. Next, if it is a AA bond, then AAA bond ka required return plus 2% extra I want. If it is a single A bond, then AAA bond ka required return plus extra 3% I want. As the rating comes down, risk is increasing. If risk is increasing, required return of the investor also increases. A scale he is giving us. Now, without reading so much, come here towards the end. Assume 364-day T-bill rate is 9%, which means 9 plus 3, here answer should be 12%. Is it 12 plus 2, 14%. Is it 12 plus 3, 15%. Are you understand, sir, how to fix the required returns? Move on. Our fellow investor is considering investing in a AA rated bond. Oh, so what is his required return now? 14%. AA rated 1000 face value bond currently selling at 1025.86. This 1025.86 is the market price. Remember, sir, whenever question gives off the market price, it can ask you only two questions. It will ask you fair value of the bond and ask a decision whether I should buy the bond or not. Or they will ask you to compute YTM. Question la market price is given means definitely they will ask either of these two questions. Work out fair value, tell me decision, or work out YTM. They asked both. The bond has 5 years to maturity and the coupon rate on the bond is 15% payable annually. The next interest payment is due 1 year from today and the bond is redeemable at par value. All normal routine data. You are required to calculate the intrinsic value of the bond. What's the meaning of the word intrinsic value? Fair value ke over action. Fair value. Should he invest in the bond? This is decision. Calculate current yield, chief formula, YTM, approximate YTM, second formula if you do, sufficient. Whatever we learnt in this chapter till now, everything is there in this question. Go on. Start. What are you waiting to copy? Do fast. Right. Required return from AA bond is equal to is equal to required return from AAA bond plus 2%. Required return from AAA bond is how much? 9 plus 2, 9 plus 3. 2. So total it is 14%. A questionable fellow is calling it as discounting rate. It has got a name. It's called as required return. He does not know. We know. First one. Intrinsic value or fair value or equilibrium value or theoretical value, all are same. Fair value of the bond is equal to, tell me sir, what are the coupons? 15% I guess. 15% on 1000. How much is that? 150 into PVIFA, 14%. How many years? 5 years. Redeemable at par and somewhere he wrote into PVIF, 14%, 5th year. $150 into 1, 2, 3, 4, 5. First to fill up this one, easy. 0.5194. No GT. Correct sir. 3.4331. Yes sir. Work out this. 150 into 3.4331 and 519.4. 1034.37. 33 you got. How? Second one 0.5194. You multiplied with the entire thing on calculator. Don't do that. Why to write then? You write something, it should match with your own answer, no? అక్కడ కక్కుడు పడకండి 1034.36537. Okay, fine. It is fair value of the bond. What is the question he asked? Should you invest in the bond? No, you decided, huh? How do you decide? Toss is error, sir. Tell. What is the actual price? 1025.86. E calculation tells you that you are mentally ready to prepare to pay how much? 1034. Bond is available at 1025.86. What will you do? Buy up? Will not buy up? Overpriced or correctly priced? Underpriced. You should not do overaction like, hey, cheap bond I will not buy. Not like that. You get higher return. Akkadi go bogodu sir. Decision. Actual market price of the bond 1025.86. Lower than fair value. Therefore, bond is underpriced. Therefore, investor should buy the bond. Okay. So tell me, if you buy an underpriced bond, how much return will you get? More than your required return. Actual return is YTM. He's asking that also. Please work out. YTM is equal to approximate enough. Coupon amount 150. Maturity value 1000. Spot price 1025.86. Life 5 years. Whole divided by 0.6 into spot price. 0.4 into maturity value. Definitely it will be more than 14%, no doubt. RR 14, it will be more than that because it's the underpriced bond. Conclusions, if you remember, life will be very easy for you. (14.26%). Marginally only higher, but still it's higher. That fellow wanted 14, e-bond is giving him 14.26. That's good enough actually. Next, poor fellow asked one more calculation. Guess how many marks ki question can come? 8. Current yield. Current yield formula is what you forgot? Coupon rate kaadu, amount divided by coupon amount in next 1 year. We'll simply write coupon amount per annum divided by market price of the bond into 100. Coupon amount is how much? 150 divided by 1025.86 into 100. Sort out this. 150 divided by 1025.86 percentage, 14.62%. This is your current yield formula. Some going to come in the exam, did not come yet. Sir, your ICMS final examination paper key, there are very limited sources, sir. A couple of foreign books are there, old exam questions are there, study material is there, CA final questions are there. For CA final people also same. They have a couple of foreign books, past examination questions, CMA final questions also they copy. So these people have some exchange program questions. So we have everything. If practice well, ideally you will not face any surprises in the exam. Okay, this is done. This one is homework, sir. You have to solve on your own. 23 you do on your own. Listen to a small, easy concept. Now you tell me this one, sir. I have forgotten. So you answer me now. I thought you will only remind me. This is holding period return, compounded terms. Earlier what did we say? It is similar to YTM and we said and we left it over there. Okay, now I will give you some numbers. You help me how to work out that. You need not actually work out, but if you tell me how to work out, that's more than sufficient. 1, 2, 3, 4, 5. This is a 5-year bond. Our boy, what he did, he sold the bond here. Sold the bond at 1050. Initially purchased at rupees 1000. The outflow. Coupons are 150, 150, 150. 150, 150. Plus last maturity value also is 1000. But our boy stood in the bond only for a period of 3 years. So I want return only for a period of 3 years basically. If you work out for all the 5 years, that is called as what? YTM. I don't want YTM. I want return for the period from the date of purchase till the date of sale, which is how many years here? 3 years. Now, HPR, simple return if you want. Simple is very easy. What you will do? 150 plus 150 plus 150 plus 1050 minus 1000 whole divided by 1000 into 100. Total coupon plus capital gain divided by initial investment into 100. That's the easy answer. I don't want that. I want compounded terms. How will you work out compounded terms? Simple, IRRA. So means what, sir? You should now fetch me one discounting rate. What is the sale value given? 1050. So you should fetch me a discounting rate which will equate the present value of all this to initial investment. So if you get me that rate, this rate is your holding period return, compounded terms. Sir, how to work out, sir? Array, sir, how did you work out YTM? Same model. YTM, how are you working out trial and error? But at trial key, who is giving you the first rate? Approximate YTM formula. Look at that approximate YTM formula and code a formula for this. So you will now tell me approximate holding period return formula. Tell. Correct answer I want. I don't want answer, I'm not interested in the final answer. I want formula. I want you to feel. Don't solve, feel. YTM lo whatever you are doing, do the same thing. It is as good as you are computing YTM for 3-year bonds, sir. Ignore these two are not there for you. Instead of maturity value, you received sale value because you sold the bond. So it is as good as there is a 3-year bond with 3-year maturity bond. That's all. Work out YTM. Call it as HPR. That's all. Name change. Tell me formula. Coupon amount. Okay. Then. No, I'm asking formula, sir. Approximate formula. How to compute is that is okay. That trial and error we can do originally, but approximate answer I want. Coupon amount plus. At that time we wrote maturity value. This is maturity value 1050. Say sale value. See, you are following now. Minus. At that time we wrote spot price of the bond. This is purchase price, initial investment. Divided by, at that time you wrote life. Is life forever? No, holding period. See, now you are coding formulas. Whole divided by 0.6 into purchase price plus 0.4 into sale price or sale value. You want answer in percentage terms? Multiply with 100. That's it. Whatever rate you get, are the approximate holding period return, compounded terms. You want accurate one? Trials. Trial 1, trial 2, somewhere you will get it. Usually holding period return, they do not ask in compounded terms. So they don't ask. If they ask, you should be prepared so that we are learning it. Is it similar to YTM or not ultimately? It's YTMA. Only thing is I can't use the word YTM because YTM and a word I can use only when I stay till maturity. I'm leaving in between only, no. So up period, holding period, and compounded term. Same story. Names change. Last concept, sir. It's called as call of the bond. Very small concept. With that we are done for today. Call of the bond. First of all, what is the meaning of call? Exact meaning of the word call you will understand after doing a chapter called as derivatives, which will come much later for us. Okay. Before that, what is the meaning of call is? Right to buy back bonds before maturity. Basically that is nothing but inka simplify cheyalante it means early redemption. Company has a right to cancel the bonds before the maturity date and repay the money to the investor. A right they will keep with them. This is called as call of the bond. I'll tell you a small story. Listen to this. Guys, my company needs money for a project. A project period is 25 years. So if I invest money now, I keep on getting inflows for a period of 25 years. And I also issued a bond to raise money for this project with a maturity period of 25 years. So what I did at 0 time, bond issued with maturity of 25 years. Now, when I issue such a long gestation period bond, if I have to convince people to buy this bond, I have to offer a coupon rate which is matching with their expectation. So, today RR in the market, let's say, is 16%. Therefore, coupon rate is also fixed as 16%. If you don't offer 16%, no fool will buy the bond unless you offer the bond at discounted price. Park, if you have to sell the bond, you have to offer coupon rate equal to required return. Otherwise, bond cannot be sold at par. No fool will pay you 1000 rupees for the bond. Of course, if you put coupon as 14%, issue the bond at 980, maybe people will buy. Because then also they will get their return of 16%. That's the reason. Okay, now, a company faces one huge risk. What is the risk is? A required return 16%, not the second 16, first 16%. That is dependent on two things. One, marketly interest rate. Number two, risk of my company only. I am the borrower there. Today maybe marketly interest rate is high. Therefore people are expecting more. Therefore I have to offer a higher coupon. I committed. But what if after some 6-7 years I found that marketly interest rates dropped? If interest rate drop, what will happen to required return? Required return also will fall. So people are willing to give me money at a lower interest rate only. But on this bond I already committed a rate of 16%. Like a fool I have to pay 16% for remaining 25 years. That is risky, no sir. I am not borrowing 100 rupees. I am borrowing 100 billion. A 1%, 2% will upset your entire company ka profits. Or understand is that company does see long period bonds law. Company does not want to take risk. Today I will offer. Today I will offer. If I don't offer, you will not buy the bond. So I will not get my money. I will definitely offer the bond at your required return only. Coupon at a fix. But there is a risk that in future, if market returns fall, market interest rate falls, RR falls, like a stupid I will be paying interest rate at 16% to you for another 20 years. A risk why will I take? I will not take that risk. So what I tell the investor is, investor, I will pay you 16% for a period of 25 years. But any time after 5 years, example, any time after 5 years, the company retains a right to call the bond. Call the bond means, you watch cricket like test match? You don't watch? Test match, sir, if your batsmen are playing too much, what will the captain say? Come back, declared. Come and sit in the pavilion, let's field now. Enough of your batting. Come off. Like that, company says, bonds are cancelled. Bonds are cancelled, you take your money and get lost. I can't pay you 16%. Why is the company saying so? Company feels like this. If after 5 years, market interest rates drop, and therefore today required return is 12% only. Company can raise the money in the market at 12%, but unnecessarily on the current bond they are paying 16%. And if you don't do anything for another 20 years, you have to do that. He will pay unnecessarily 4% extra on 100 billion. I will not pay. So what I will do, I want to cancel the bonds. I will tell that point before only. Company has right to cancel bonds or cancel bonds. Let's call it as refund bonds. Now tell me this. If you are an investor, You saw a company offering a 16% interest on a 25 years investment. What you thought is, just now I'm starting my career. Whatever money I have, I'll dump into it. Nice 16% return. Forever I will get for a period of 25 years. Happy income. But you read in the document that that fellow says I'll cancel the bond at the end of 5th year if I want to. That will be a kind of hindrance for me. I want to invest because it's for a 25-year bond. But you are saying that you will cancel the bond after 5 years if it is suitable for you. Then why will I buy the bond? I will not buy the bond. So company says, don't worry. In case I cancel the bond, I will cancel the bond at premium. I mean, if you stay for 25 years, last I will pay you 1000. If I cancel it, I will pay you 1100. So investor, how he thinks is, if the company does not cancel, then I will get 16% per annum return for 25 years. I am happy that way. If the company cancels the bond, then I will anyway get premium on redemption 1100 instead of 1000. That way also I am happy only. So investor will eat off this biscuit, sir. Premium on redemption is there. So bonds are early redeemed at premium. Let us say example. Okay? Bond is originally issued at 1000. Now, let's say redeemed at 1150. What is the meaning of the word yield to call? Means from the date of purchase till the date of call, what is the compounded return earned by the investor? What is YTM? Yield to maturity. Yield to maturity means what? From the date of purchase till the date of maturity. Our period ka compounded return is called as yield to maturity. Suppose this fellow sold the bond at 8th year. Date of purchase to date of sale, that is called as holding period return. Date of purchase to date of call, that is called as yield to call. Date of purchase to 1 year is called as current yield. Whatever 4 returns we learnt, all returns ka time frames are different. Current yield will see only for 1 year. Yield to maturity will see for maturity date. Holding period return, date of purchase to date of sale. Yield to call will see from date of purchase to date of call. Call means early cancellations. Now you will tell me, apply your mind correctly and answer this. Cutely answer. Yield to call formula. YTM formula you know. Coupon amount. Next. Maturity value is a word which you use in YTM. Holding period return lo use the word sale value. Redemption value or call price, both are correct. Very good. Redemption value is correct. Call price is also correct. Minus SP spot price or initial investment, anything, divided by life, not life. Holding period, no. Or redemption from the date of purchase to date of call. To date of call. Whole divided by 0.6 into your spot price today plus 0.4 into redemption value outside into 100. YTM, if you understand, all compound returns are same to same. YTC is done for you. Tell me, sir, is accurate YTC? Almost accurate. Almost accurate. Accurate you want, you have to do trial and error. E rate to discount all the cash flows. It won't match. Slightly increase it. Still it won't match. Interpolate it and get it. The accurate YTC. Nobody will ask you accurate YTCs usually. So this is the maximum. This is the call of a bond. Tell me, sir, who is exercising this right here? Company is exercising the right. The reverse is also there. This is called as put off bond or puttable bonds. This time The investor has a right to surrender the bond. Surrender, or you can say sell the bond to the company before maturity date. This is called as put of the bond. Call ki put ki, what is the difference? Call, the company is having the right to buy. Here investor is having the right to sell. Company point of view, if you talk the second one, I have an obligation to buy this one. Whereas here I have a right to buy. Here I have a obligation to buy. Now you tell me, sir, what is the meaning of yield to put? Meaning, formula will work out. Yield to put ka meaning. It is return from date of purchase to date of put or date of surrender. The yield to put. The callable bonds are the puttable bonds. First page of our concept book, callable, puttable bonds, and one introduction is there. If you want, you can check it now. Callable bonds means company reserves the right to cancel the bonds. Puttable bonds, investor has a right to cancel the bonds. Whoever cancels it, ultimately company has to buy back the bonds. Now you will tell me approximate YTP. Tell. Coupon amount divided by here redeemable value. Here also same thing, or you can call it as put price. Redemption value or put price. Excise price. Anything is okay. Minus spot price divided by period till you put it till then. 0.6 into spot price plus 0.4 into redemption value outside into 100. The approximate yield to put wala formula. On this yield to call, yield to put, there are small questions, sir. Once we do that, one ultimate concept is there which is called as reinvestment rate assumption. That's linked to YTM only. Once we do that, we cross the second level of bond valuation, YTM is done. Then we are left with convertible bonds, forward interest rates. Forward interest rate is like little high notch, but convertible bonds is easy, extremely important also. So tomorrow's session, most probably, almost it will be over for us bonds. Tomorrow's session, little may be left. Okay, we'll continue on this tomorrow, sir. It will be too much for you. So whatever we have covered till now, kindly revise and come back. See you guys. Thank you so much.